Hi guys, so good morning to everyone listening. My name is Kalu Ajar, and today we have our webinar Understanding Indicators. So just a quick check to make sure you all can hear me. If you can, just show hands, and then from there, I'm just going to continue, right? Excellent, thanks guys. Okay, so let's get right to it. So we have our topic on understanding indicators. And as usual, this webinar is sponsored by the podcast, The Way I See It, which is the podcast where we talk about money, personal finance, the economy, and how it all intersects and how we try to learn from them. So that's a Twitter handle underneath. If you're not following on Twitter, please do. That's the YouTube channel as well. Once we're done with this, we're going to load the video on YouTube. So it's a good resource for you to go back and see past videos and also to refresh on this video that you're going to watch today or this webinar here. So why are we doing this? It's very important to understand that what I'm trying to do is just education, financial education. I want to make sure that people understand and have a better idea of what financial literacy is. That's for me personally. But if you look at what Alan Greenspan, who was the chairman of the Fed, I think it was the second longest chairman of the Fed, the US Fed, he made this unique quote: the number one problem in today's generation economy is a lack of financial literacy. This guy was the Fed chairman when you had the Gulf Wars, when you had the recessions, when you had the boom. And he's saying that to him, the number one problem is a lack of financial literacy. That is very, very key because if you don't understand what debt is, you get into debt and that can kill the economy, just like we saw in 2007 financial crisis. So it's important that as we are trying to be better investors, we understand what investing is. We have to go beyond just understanding what stocks and bonds are to understanding how the economy works. If we get an understanding of how the economy works, it's easier for us to become better investors. So with this webinar, I want to talk just outside the core of actual buying and selling and choosing investments. To talk about the economy, the indicators, what does GDP mean, how are those connected into personal finance. It's not really going to make you an economist. If you go through this webinar, you're not going to become this PhD economist, but it's going to give you an idea of why you see on the TV, on the radio that talk about money, people talking about GDP or unemployment or credit. Why is it important? And if you have the understanding, it allows you to then do further research on your own and you're able to basically be a better investor. That's basically what it is. So we want to understand those indicators to allow us to become better investors. Okay, guys, so I have this dashboard. This is a Mercedes-Benz AMG. If I showed you guys this dashboard, what can you tell me about the car and possibly what's happening just, just by looking at this dashboard? You all can talk back, so I'm going to try. If you send me a text, I'll read it. But let me try to hazard a guess what I see just looking at the dashboard of this car. And if you post a note, I'll see it. Yeah. Now the car is going about. We can see from the speedometer, the car is going very very fast. It's about 240. I think that should be kilometers per hour. Yeah. So the car is going very very fast. We can also see that the car can keep going for a very long time because the gas is got about three-quarters tank. The tank is full by about three-quarters, so it's got a lot of gas to go really really fast. Yeah. I can also see it's on the fifth gear. I think that's what that means, which means it's cruising. So he's not going, he's going fast and he's basically cruising. So he's on a very, very long and good road, literally. We can see his odometer there at about 7. So the engine is revving, you know, and we can see to the time, we can see the temperature, we can see how long he's gone, about 243 kilometers. Just by looking at the dashboard of this car, we can have a sense of the type of road he's traveling on and how fast it's going. We can know, oh, we can do a calculation if we wanted to know distance. We can say, oh, if it's going 243 kilometers and it's going at 240, that can tell us maybe distance. We can do all that with just looking at the dashboard of this car. We don't have to know who is driving it. We don't have to have special skills. Just by looking at this dashboard, we're able to tell a lot about where this guy is going to, right? Someone says it's a manual transmission. Okay, I don't know that much, but I'll take your word for it. But you can see we can tell a lot just by this dashboard. And basically that's what economics or economic indicators allow us also to do. By looking at the economy and looking at inflation and looking at GDP, we can tell a lot about the strength, the health, the direction of any economy. We can also do a projection and say if CPI is this or inflation is that, this is what's going to happen to the economy. That's the whole idea. So we're just copying this analogy and then moving it over to economics per se, where we then try to say, okay, if this is what the car is doing, then can we hit that same understanding and then use it to understand what the economy is doing? For the economy, this is what our dashboard might look like. There are many economic research reports that you have out there, many of them, and they're all going to have either the same or types of the same information. In this instance here, we have monetary policy, economic outlook, you have the yield curve. This dashboard has a lot of indicators on it. And basically you can read these indicators just like the same way you read the dashboard of a car. If monetary policy is going higher or inflation is going green, what does that mean? How do you use that information to be a better investor? That's basically what this is going to allow us to do. But for indicators, we have really three types of indicators. So it's good that we get that out of the way and you understand what this means. So when we say forward or lagging, you're basically on the same page. Now you can have a leading indicator, you can have a coincidence indicator, or you can have a lagging indicator. And nothing too special. If it's leading, all it's telling you is that that indicator basically goes before something happens. Let's just use simple English. So a leading indicator is going to be something like the consumer price index, the CPI. Inflation is calculated by the change in the CPI. So let's say in the consumer, the CPI or a basket, we put a basket and we put yam, we put gari, and we put 4 liters of fuel. How we measure inflation is that we calculate the difference in the price of that basket. The basket price goes up, then inflation goes up. So as you can see, if the CPI, which measures inflation, goes up, that tells you that inflation is going to go up. So it's a leading indicator. It happens before the event actually happens. That's leading. What about coincidence? So it's happening at the same time that the economic event or economic change is going to happen. For instance, GDP. If you calculate GDP, which is just going to be output, if you measure GDP and you say this bakery makes 200 loaves of bread, that's GDP. There's no leading or lagging. If that's the GDP you've measured, that's the GDP for the bakery. So it's almost the same timeline. But if it's lagging, basically you are saying that the business change would already happen before you then see this indicator then catching up or coming after the business change. For instance, take life expectancy. If you have the citizen earning more, if wages go up and the standard of living is then going to go up as well. But the living will be measured after the event has occurred. So if the economy earns more money and people do better, then their life expectancy is going to go up. But you're going to see life expectancy go up after the economic change has happened. So just keep it simple. It's either a leading indicator or coincident indicator or it's lagging. Just to get that out of the way for you guys. Nothing too complicated there, right? Now let's go straight into the indicators and the economic terms that we want to basically look at. And guys, there are a lot of them. There are a lot of them. I have had to cut down this presentation to make it as simple as possible without talking too much about economics. The idea is to give you guys how it's done, then you can go back and read up on it. But if you want to look at indicators, I mean, you have GDP, you have the GDP growth rate, you have inflation, you have balance of trade. All this stuff here are all indicators. And the thing with indicators is the frequency of how it's measured. For instance, you have the GDP growth rate, which is measured quarterly. The annual GDP rate is also measured quarterly. What about inflation? As you can see on the chart on your left, that's measured monthly. What about interest rates? That's measured daily. So all these indicators, just like a dashboard on the car, where speed is measured immediately. So speed is, for instance, is a coincidence indicator. But what about engine oil? Normally, your engine oil reading is best done in the mornings, right? Or in the evenings after you've parked the car when the engine has cooled down. You really can't measure the engine oil once you've started the car because it's has, I don't know the engineering intent, but you don't do it when you start the car. So the same way with economics, you either measure at the very, very beginning and get your forward indicator, or you measure at the end to get the lag. But these are basically the universe of what you want to measure. And there's much, much more you can measure. But this lets you have an idea of the direction, of the speed, of the strength of any economy. So if you ask yourself, if inflation rate is going up, is that good or bad for the economy? Of course, you might say, oh, it's bad for the economy. So if it's bad for the economy, what do I do? You then take action with your personal portfolio. But if you wait for inflation to go bad before taking action, you are already too late. So indicators allow you to determine what inflation would be in future by using the data that you have today. That's the whole idea. If you then see that wages are going up or government spending is going up, that's an early indicator of inflation. So that way you can then position your portfolio to take advantage or to protect your portfolio from the changes that are going to be brought about by inflation. That's basically what we're doing, guys. Nothing too complicated. So lots of terms here. I'm just going to select a few and talk about them, but what I think are very, very key. I'm just going to do a few of them. When we analyze indicators, we're trying to look for two things. Number one, we are looking at the trend. We're not looking at the particular number. If you simply take GDP for 2021, it tells you nothing. It's just a figure. You have to compare 2021 to 2020 for 5 or even 10 years or more. You want to see a trend and you want to ask yourself, what is the trend telling you? Is there a bump in the trend? Is there a valley in the trend? Has it gone up or has it gone down? Why did it go up? Why did it come down? Are expectations already baked into the trend, or is a trend just waiting for the market to catch up? You have to ask those questions. You are looking at a trend. You want to understand where the economy is going by looking at where the trend has been for the last 5 or 10 years. Then you want to ask yourself, that trend, is it being sustained? What's sustaining it? Is it sustained by this factor or that factor? If you understand what sustains a trend, that means you can predict where that trend will go to by looking at the sustaining factors. That's basically what we're saying, right? So you want to understand what the trend is showing you and how the trend has been sustained. So pretty easy as well to understand that. Let's pick the first one, which is going to be the most common economic indicator out there, which is going to be the gross domestic product. I did a tweet chat on GDP a while back, trying to use very, very easy language for you to understand. But GDP, it's simply output. Look at it that if you have a bakery and the bakery is making bread, the GDP of that factory is going to be the number of bread the factory makes multiplied by the market price, the output, the physical bread. If you're taking flour, if you're taking sugar, if you're taking salt and yeast, all that is going to be input. Then the GDP, then if the factory makes an output, that output is GDP. So economists will tell you that if you can measure what the factory is producing, you can tell if the economy or the bakery is doing very well. So obviously, if the bakery is producing a lot of bread, that tells us that that bakery is really doing pretty well. If the bakery is doing low, not a lot of bread, we can ask ourselves, why is it doing a lot of lower bread, or why is it doing lower supply of bread? That also gives an idea of the strength or otherwise of the bakery. So very, very easy, nothing to worry about. And these are the components of GDP. This is what's going to drive the trend of GDP. It is going to be consumption, investment, government expenditures, and then exports. So the difference between import and export, i.e. the net, right? So back to what we talked about, we want to see the trend of GDP, and we want to know what is driving that trend of GDP. If we know that GDP is based from consumption, investment, and government expenditures, then we don't have to look at GDP when it occurs. We can go ahead and look at what is the consumption of the citizens in the country, what is the investment, what is the government expenditure. If we have an idea of that, then we can say, well, we think GDP is going to go up or it's going to come down. And if GDP is coming down, that's a bad thing. So if we know GDP is going to come down, then we take action. What do we sell? What do we buy? If GDP is going up, the economy is booming. So we want to get into equities because we want to buy into a variable asset that is basically going up. If GDP is coming down, that's going to be bad. So we want to quickly rush into bonds for protection and for guaranteed return. That's the whole idea, guys. If you understand what's going to happen in the future by looking at the indicators, then you can go back and you can take action with your portfolio. But let's move ahead. So now I've given you the actual trend. Now, remember what we talked about? You know what indicator you want to look at, and then you want to look at the trend. So I'm just picking a few indicators that I think are very, very important for you. So you obviously have to start from the GDP. You want to look at the output. And what I've done here for you, I've given you a 10-year trend series. So you have the GDP on my left, which is just going to be the raw nominal GDP per year, starting all the way from 2011 all the way to 2021. That's the GDP figures that we have. You can see the crests, you can see the valleys. Then on the right-hand side, I have the annual GDP growth. So we have the GDP, but how is that factory, how fast is that factory producing bread? That's what we have in the annual growth. If you look at Nigeria's growth, let me see if I can go to get a pointer so you guys can see where I am looking at so you can follow. Give me a quick sec right here. I've got a, and I'm going to do a spotlight. There we go. Okay. So if you guys look here, you can see this is when we had the recession in 2016, 2017, 2018, right here, right? And you also see the issue we have here with the COVID recession as well. So this is the growth. When you have two periods, 2 quarters of negative growth, that's the recession. That's why we had the recession here in 2016, and we also had the recession here in 2020, 2 quarters, right? So this is basically telling you what's happened to GDP. You can say GDP went up all the way from 11 to about 14, then crashed, stayed down, went up again, and then came down again because of COVID. And you can see the growth. So with a chart like this, what I'm looking at to say, what's the trend telling me? The trend for, you can see the trend for Nigeria, what the long recession here, then we came out of a recession. But look at how we came out. We are just under 2% growth. Nigeria's trend used to be about 4, 5, 6 on the average, well before 2016. But now we've come out of recession, but we are still experiencing very, very low growth at about 2%. That's the trend right now. That's what the trend is telling me. So I'm going to focus on the fact that Nigeria has got very, very low growth. If Nigeria has very, very low growth, then it's also difficult for your variable income or those kind of assets to then make a lot of money for you. You want to now look for assets to buy because the market or the economy or that bread factory we're talking about is not really producing a lot of bread. So people are not really getting a lot of jobs. There might not be a lot of cash in the economy. Disposable income might be lower because the GDP here, even though it's growing at 2%, but we've been coming off a GDP that is growing on the average 4, 5, 6. So that's the key thing to take a look at here. And you can see going forward, the economy really is in a recession, although it's come out of the recession, as you can see in 2021 here in the quarter, but it's still a long slog. Look at it, you can barely see the return or the positive return in that quarter and third quarter of 2021. So this is what the trend, how you look at it. What's the trend saying to you? How is the trend being sustained? What is causing this GDP here to fall? If we know that GDP is going to be consumption, going to be government expenditures, going to be net import and export, we then go back and ask ourselves, what are those indices doing? And those indices are doing very well, GDP will go up. GDP is just the answer. The components are really what is driving GDP. So GDP is a must for you to know. You have to understand how it's calculated and you can build out this series. On this chat, I'm using what's called Trading Economics. It's a site online, Trading Economics. You can go to them. You can look at all these figures. They go time series. They go back 15 years, 20 years. So it's a very, very good place. I recommend that you do that. I'm using only Trading Economics, so it's easier for us to follow. But there are tons of sites online that you can get your information from as well, right? Okay, so let's take a look at my other chart that I have here to try and see if I can show you guys something else. Yeah, so yeah, I'll take questions at the end. Don't worry. At the end, I'll take questions from you. So just try to listen and try to follow. Take your own notes, but I will take questions at the end, not to worry. I'm just gonna go out, guys, so I can come back in. Yep. Okay. There we go. So the next indices or indicator I'd like to also talk about that we have to know is going to be what's called the PMI. PMI is basically the Purchasing Managers Index. Look at it this way. If you had a town and you wanted to know how strong the town was economically, who would you ask? You might say, okay, I'm going to ask all the cooks in the town, because if the cooks are buying food from the market, they would have a better sense of if prices are going up or if prices are coming down. It's the same thing with the PMI. With the PMI, we're asking the purchasing managers in companies, what is your outlook for the coming month or coming quarter? Because if the companies are bullish or they are positive or they are confident about the economy, they're going to be buying raw materials or they're going to be making investments. So these companies, if we see that companies are investing in the future, that is a positive sign, because that means that the economy is expanding. If the PMI shows that the companies are not spending money on investments, then that's a negative sign, because that means they are not sure of consumption in the future, hence they're no longer investing. So the PMI at least gives you an idea, right, of what's going on in the economy in terms of purchasing power, in terms of consumption, from the lens of the managers that are buying inputs for to manufacture stuff. So the same thing, I've given you guys a 10-year time series because I want to look at the trend. I want to, even if I do a visual look at the trend, I can see what's going on. And then I can say, okay, what's driving this trend and what's the trend telling me? If you look at the one on the left, the PMI on the left, which is going to be the longer PMI all the way from, I believe that's going to be 2001 till 2020. So longer time series there. You can see the average visually is about maybe 50. So that's crashed in the year 2000 because of COVID, and it's come right back up to 50. But it's still below what we had from, say, the year 2015 to the year 2019. So even though we're doing pretty good, yeah, we're still below where we were before on that PMI. And I've broken the PMI on the monthly scale for you in 2020 on the chart on the right. So you can see in April, June, July, August, so we're like stabilizing at nearly at the 50 or 49 percent mark, which is good for the year 2020. These are the latest figures, by the way. But we do not have we can say we are going back to the top, but not yet at the top, right? So that's what the PMI is telling us. So again, with the GDP and the PMI, we can get a sense of the spending, of the confidence level, of the level of capital investment in the economy. And we want these things to be positive. If they're not positive, then we have to be worried and say, okay, maybe if we go invest in new accommodation or new housing, there might not be tenants that will take up that building. That's the whole idea, guys. Again, we are not going to make you economists in just 1 hour, but I want you guys to write down GDP and PMI and go back and read it and try to become an expert in it. Now, the inflation, I see your question. Don't worry, I'll take a question at the end. Yeah. The inflation is now one of the key things. The inflation is one that you really have to know, because you might argue that, okay, I don't see GDP, or it's esoteric, or it's out there. PMI looks a bit elitist, it's purchasing managers, but inflation affects every single person. You cannot avoid inflation. Once you're in an economy, you cannot avoid inflation. You can't diversify away, you can't hide, it must affect you. So inflation is very, very important for us because even if you have savings in the bank, if there's high inflation, your savings are worthless. If you want to invest and there's high inflation, you can't invest because you cannot plan. So if we know the direction of inflation, it tells us a lot about what we should do. Some inflation is good. If you have zero prices, that's not really a good thing. In Japan, the problem they have is there is no inflation. So they are trying to create inflation in Japan. They can't. So that's the big problem they have in Japan. In America, there's a lot of spending, and inflation for now is still muted for now, because for now we think it's going to go up, but for now it's still muted. But in Nigeria, we have runaway inflation. So it's been galloping, and it's now starting to affect asset values and also the consumer confidence of individual investors. So same thing, I've done the core inflation on the left, but I've done food inflation on the right. Let's look at core inflation. Look at the trend. What's the trend telling us? From 2011 to 2020, even if we look at it visually, then we can take an average, ignore the big bump. This is the thing you have to learn with statistics. See that big bump, 2016, 2018. Let's just say that's an outlier. It came up, it went back down. Let's just say that's an outlier. We can see that the total inflation has, give or take, on the average about 10. So we've stayed at 10 or single digits, or just that 10, 11 mark from about 2011 to about 2021. Look at the period that we had from all the way, I believe that's about 2013 to 2016. That was below single digits all the way from 2012 all the way to 2016. Single digit inflation, consistent. It didn't go above, even slightly just touched 8%. That was inflation. Then we had 2016 where inflation went all the way to 18, came back down, and now it's at 12. So core inflation, which is a measure of basic goods in a basket, just a random goods in a basket, is going up. If inflation is going up, you want to be very, very careful, because you don't want to be in fixed income. You don't want to be in bonds if inflation is going up, because it destroys the value of those bonds. You want to be more in equities or in commodities or in assets. That's why you see the Bitcoin and the cryptocurrency craze raging, because value is being destroyed in fiat currency. So more people are now looking for assets that can hold their value. Hence, you see the growth in the digital currencies and the like, yeah, that are more or less pegged more to the dollar and a bit more stable. But interestingly, let's look at the food inflation. If you look at food inflation, it's a nicer graph, where you have from 2012 all to the 2016. You see that same bump in 2016 as in core inflation. You see that same bump again. But look at the problem with food inflation. While core inflation is going up at a slower pace, food inflation is just going through the roof. So I mean, you can see that from say 2019, it's just been constantly increasing. So this for you will tell you, wait, why are food prices going up and general prices are just staying more or less going up in a slower level? That tells you there's something external happening to the data set. What's the externality happening? Border closure, Boko Haram, all that stuff. That's what you're seeing in the food inflation. You get a point I'm making. Normally the food inflation, yeah, should tie in with the core inflation. But in this case, take a look at the last chart. You can see it all the way to about almost 25%. But food inflation but core inflation is give or take about 12. So this growth that you see here in the food inflation is brought about by lots of external forces, which you can say is the closure of the border. So we don't have much food coming in. Also, the activities in the planting areas in Nigeria, where you have lots of the issues with the nomadic herdsmen and the traditional farmers. That's also affecting harvest. If harvests are lower, that's lower supply. If there's lower supply, cost of goods go up. Cost of goods go up. You see it here in the food inflation. And you can see the difference between that core and the food. So food is just going through the roof, telling you there's very, very limited supply of food, which is why the cost of food is going up. Inflation is very, very important to us. Like I said, it affects everybody. And the CPI, that consumer price index that we talked about, is almost 50% food. So that tells you that if we simply can address the cost of food, then the cost of inflation in Nigeria also goes down. So for policymakers out there, just targeting food prices can have a big impact in resolving galloping inflation in Nigeria. So that's something that we should also take a peek at, seeing if we can focus on that for food inflation. Yeah. Okay. This is the one that is a bit heartbreaking, the population and the unemployment rate. So I try to put these two together to show us how we can marry two data sets and then try to get information. On the right is the Nigerian population, and you can see steady growth. I mean, Nigerians are steady. The population is growing as a steady take of about 3%, no break. Look at 2012, 2014, 2016, 18, 20. It's just a steep line. So more and more and more Nigerians are being born. And so we have a very, very young population, extremely young population in Nigeria. The problem is going to be on the other chart. If you go to the other chart, you also see that chart going up steep as well. But that chart is unemployment. So you have a situation where people are being born, they go to school, they enter the labor workforce, but there is no job. So they are unemployed and underemployed. So you have a lot of youth in Nigeria that cannot get a job. This is very, very important economic data set to look at. If people in the labor force, i.e., people that can work, cannot get a job, then they cannot earn an income. If they cannot earn an income, they cannot spend. If they cannot spend, what does it affect? It affects consumption. Remember the GDP? What are the features or the feeders to GDP? Consumption, government expenditures, import and export. Poor people cannot afford imported goods. So import export is out of the way. Poor people without a job cannot consume, in quote. So that's also out of the picture. So when you see a high unemployment rate, what that talks to you is about consumption. There is very, very low consumption. There's very, very low savings in the economy because people are not earning enough to save and then invest. So it's a very, very bad data for you. If people start to get jobs, then you start to see a propensity to spend. There's now velocity. People are spending, companies are hiring. So it turns to a vicious circle that the more you get a job, the more you spend. The more you spend, the more companies hire. The more companies hire, the more you get a job. So it just has a positive cycle going up. So again, unemployment is one thing that the Nigerian government has just got to focus on and say, we want to solve it. And there are tons of ways you can solve unemployment. At this stage of unemployment, where there is just a chronic, hardcore, baked-in unemployment, you just want to do direct government stimulus. In America, in the 1920s and 1930s, when they had the Great Recession, the US government was paying people to dig holes and put them back. The idea is just get people money in their pockets, give people cash by employing them so they can go back out to spend. You want people to spend because the more people spend, the more the economy is reflated. That's the whole idea. Unemployed people do not have income, in quotes, so they cannot spend. If the economy is not spending, then there are no jobs being created, and then you have a chart like this. This we must address. Otherwise, I mean, who are you going to sell to? This has security implications. This has got inflation implications. So unemployment is also a key indicator that in Nigeria we have to solve. So we've done GDP, we've done PMI, we've done population, we've done core inflation. These are things that you must, as a minimum, if you are doing your economic planning, understand what they mean, what is driving a trend, and how those trend lines can be interpreted for you to determine where to invest in, right? Now, indicators answer questions. So guys, like I said, I've just given you, I showed you a universe of total indicators, or tons of them. I picked just a few of them: GDP, PMI, inflation, unemployment, right? And I've just explained to you how we look at the trend, how we can ask questions. Even if you look at it visually, you don't have to be an economic, just a visual comparison of the trend line gives you lots of questions that you want to go answer. And when you answer those questions, it helps you as an investor, right? So let's do an example of that. So we said indicators answer questions. What do we mean by that? Yeah. Why is the Naira weak? If you ask people why is Naira weak, let's assume that the weak Naira is, let's just forget whether it's good or bad. The Naira is weak. By weak, I means it's about let's say it was 400 in January and it's now 420. So it has lost value, i.e. it is getting weaker. We're not talking whether it's good or whether it's bad. We're just saying, how can we know if the Naira is weak by economic indicators? Okay, what makes what do we say we do? We look at the trend line. So let's assume we've seen a trend line. We all know what the Naira to dollar rate was in 2020, 2019, 2018. We all know, right? Let's assume we know that picture. The picture, if you don't know, I'll let you know. The Naira has been getting steadily weaker on the market. So the dollar has been gaining strength to the Naira. That's the trend line. We're now asking ourselves, what is feeding that trend line? Because if we understand what's feeding the trend line, we can predict where the Naira would be going forward so that we can take an informed decision. That's what we're doing. So we've got a trend line. We want to now see what's feeding the trend line. Number one, imports. And I'll keep it very simple. If you import more, then your currency value falls. Easy, yeah? Number two, exports. Again, if you export more, then your currency value rises. We're not going to go into why or how. I'm just going to give it to you guys, right? Foreign portfolio investment. This is like Nigeria has euro bonds and a US bank buys euro bonds. It's not investing in, say, a railway, but they're investing in a Nigerian issued security. So Nigeria is getting dollars and they're giving that US bank a piece of paper called a bond. So foreign portfolio investments. The more foreign portfolio investments you get, then your currency becomes stronger. So that's why you see US dollar with all the spending that is done in the US, all that spending, they don't have inflation per se. Because why? Because everybody is trying to buy the US Treasury bonds because they're the safest investments in quote in the world. So if everybody is buying, then the US government can finance their debt by simply selling US government bonds at nearly 0%, and people will still oversubscribe. Hence, the US government can borrow they can keep debt larger than their GDP because the cost of that debt to them is really nothing. That's the whole idea. So foreign portfolio investment, if it goes up, your currency is stronger. Foreign direct investment. So let's say GE is opening up a railway factory in Calabar. So GE will buy land, they'll buy water, they will pay salaries, all that FDI, that's imports coming to the country. So instead of it being the import, you're bringing in capital into the country, capital importation, which is good for your currency, right? And of course, we have remittances. So Emeka is sending money to his mother. He sends $1 to his mother. All that inflow of dollars also helps your local currency go up. So these are the factors that are driving currency rates in Nigeria. If imports go up, currency falls. If exports go up, currency goes up. If FPI goes up, currency goes up. If FDI goes up, currency goes up. If remittances go up, currencies go up. So from up, the only thing we have is for imports. Imports has got to be lower for the currency to go up, right? So now we've seen the trend. We've seen what is driving or what's feeding the trend. Let's now ask ourselves, what's going on with import, with exports, and remittances, right? So we can then see if we can project what the Naira would be going forward. Also, yeah, I forgot loans. So if you take loans will be like FPI or FDI. So if you take loans, then you have more dollars, so your currency also goes up. Yeah, guys. Okay, balance of trade is just a fancy word to say the difference between your imports and your exports. So if you import more, you have a negative balance of trade. If you export more, you have a positive balance of trade. So this is Nigeria's balance of trade from 2011 all the way to 2021. And the picture is clear. You don't have to do analysis. Just look at the picture. You can see we've had positive balance of trade all the way from about 2011 all the way to 2016. Then it went negative because of the recession. It went back positive. It went back positive, a few bumps and bruises there. But from 2021, you can see the trend. It's been very, very negative. What does that tell us? Nigeria is importing more than Nigeria is exporting. And what did we see in the previous chart? If you import more, your currency loses value. I don't want to go into the why because that will take us to a totally brand new topic today. But let's say we can have a different chart later on, but that's basically what's going on. Because Nigeria is importing more, you can see from 2020, we have the gray. Because we're importing more stuff, our currency is not getting that strong. So really easy for us. What are we exporting? What are we exporting? We export crude oil. And look at the chart. All that blue line, the blue spaces here, that's 87% of Nigeria's exports are crude oil. Every year since I was born, we hear everyone say, we're going to diversify, we're going to diversify, we're going to diversify. It's all talk because in reality, crude oil is still 87% of government revenues, i.e., foreign exchange revenues. By GDP, crude oil is less than 15% of the Nigerian economy. Crude oil is a very, very small part of the Nigerian economy, but by foreign exchange revenues, it's huge. It's large, almost 80, 90% of the foreign exchange that Nigeria earns comes from just one source, crude oil. And as you can see, we're making about 46 billion from oil, but only 311 from cocoa, oil seeds 300, fertilizer 115, edible fruits 113. So there's really no comparison. If Nigeria stops selling crude oil, I don't know what's going to happen. We haven't built up other sources of trade. So apart from crude oil, we have no, in quote, other sources of forex in Nigeria. And that's the problem. So remember we said if imports are high, your currency falls. If exports are high, your currency goes up. But we're exporting just one product, crude oil. And what's happening to crude oil in the world? Prices are down. Why? Because of COVID. So that makes our currency also get weaker. This is imports. This is what Nigeria is importing. Like I said, we can go into detail here, but not necessary. What we want to know is that the balance of trade, as I've showed you guys before, is negative for the Naira because Nigeria is importing more. So the Naira is becoming weaker, right? This is what we're importing from. We're importing from China. So people always ask, wait, but why China does not use dollar and we're importing more from China? Yes, but look at India uses a dollar, US uses a dollar, Netherlands uses a dollar, Belgium uses a dollar. When I mean uses a dollar, the dollar is the reserve currency for trade globally. So even if China says we're not going to use dollar, we're going to use digital yuan, if you combine what India, US, Netherlands, Belgium, Italy, Swaziland, or if what they all do, then compensates for the Chinese yuan use. So we can't escape the dollar. If we are importing more, we're going to need dollar. If we need dollar, that means Naira is falling. We can't escape it. That's really the issue. So the question, back to the question, let's conclude it, then we'll ask the question again. Look at the big one here, remittances. This one is just, you don't have to be an economist to understand this. From 2018 till 2020, remittances on the average were doing about 5.9, 5.7 and all that. Then in July, they crashed to 3.373. What happened? All that stuff about dollar here, you can't pay dollar here to your bank. You have to go to the bank, line up all those CBN policies. This is the result of it, where you see the crash. Yeah. And it's time to grow up again. But it's just the uncertainty around remittances. It's also the COVID. People lost their jobs in the US and Americas and Europe and all that. So people are holding back. There's not a lot of money to also transfer back to Nigeria. So all that is feeding into remittances. And Nigeria gets about 25 billion from remittances, minimum. This is official figures, so it might be up to 50. Nigeria gets more money from remittances, i.e. physical currencies, forex currencies, than even crude oil. because you get more by gross volume from crude oil. But remember, Nigeria has JVs, that's joint ventures, and production sharing contracts. So we don't get that full money from oil, and we also have costs in oil. But when you send the remittance, there's no cost. Nigeria is getting 100% gain on that remittance. So if Nigeria makes $100 from crude oil sales, we do 50% or so with the oil major that got the oil, we pay costs. The rest is Nigeria's, might be $20 out of 100. But with remittances, if you send $100, we get $100, we move on. So you can see the remittances are low. If we go back to what we said, why is an Naira low? The question we're trying to ask ourselves is, we want to use the indicators to project. You can see what's going on. The Naira is low because the feeders to the strength of the Naira, those indicators are all negative. We have a higher imports, we have lower exports, we have lower remittances, and we've seen that right here. So once those are lower, you can then see that the Naira is always going to keep on losing value. So if you want to project the value of the Naira going forward, what would you say? You don't have to go to a Babalawo. You simply look at your remittances figure, your imports and exports, which is the balance of trade. If that trend keeps on going the way it's going, then the Naira is going to keep on losing value. Easy. There's no magic to it. If we keep on importing more than we export, then the Naira is going to keep on losing value. That's how indicators answer questions. So if we then have a portfolio that we are building that is heavy in just one currency, the Naira, what should we do? We want to diversify, we want to hedge into other currencies so that we can ride out the storm of a weaker Naira. That's the whole idea. And we know Naira is going to get weak because we have seen that imports are higher, and we don't see in the near future imports changing or that figure turn around. That's basically what you want to do, guys. You take the indices, look at indicators, look at the trend line, ask what's fitting the trend line, make a determination, and then you take action, right? I hope that was easier said than done, but you get the idea. I reserved a whole chapter on Nigeria's crude oil. I want to use indicators to ask you guys questions. I know you guys can answer. I'm going to look at the charts. So if you guys type in your answers there, I can read it off. Yeah, we're almost coming to the end, but this is what I try to do. So crude oil is Nigeria's key indicator. So like we've talked about, I'm trying to summarize everything back to this, that if you had to pick one indicator to give you the future direction of Nigeria, what would it be? It would be crude oil. So just like we said, GDP is important, PMI, inflation, import, everything is important. But if I had to pick one thing to say, what would I use to know if Nigeria is going to be, the Nigerian economy is going to grow or shrink? I would simply pick the cost of crude oil. Let me show you what I mean. Is oil GDP? Yeah, so now I'm going to just go to the chat. So in case anyone has, if you guys answer, I'll see it. Yeah, but I'm not going to, no. So look at the, let me put this off here. Look at the oil exports. Then look at the annual GDP growth rate. What can you see? The oil exports is just a proxy for exports. It's a proxy for the strength of the Naira. It's a proxy for dollar income. So if you look at this, the GDP, the oil exports, look at the GDP, what do you see? What's the correlation? Can you guys see any correlation? If you type in a text, I'll see it. Otherwise, I'll just go ahead and answer. Look at 2016. If you see 2016, you can see the dip in oil exports in 2016. Look at 2016 GDP growth rate. You see the same dip? Great. Come back to 2020. Look at the dip in oil export in 2020. Look at the dip in GDP in 2020. More or less, when Nigeria exports more crude oil, the GDP growth rate goes up. If Nigeria exports less crude oil, or if the price of crude oil falls, Nigeria's GDP growth rate also falls. So oil and GDP in Nigeria seems to have this positive correlation. Why? Because it's like I said, Nigeria is making almost 80% of her forex revenues from just crude oil. And crude oil is basically the dollars from crude oil is what's funding to a large extent the budget, i.e. the profits, petroleum profit taxes and all that. So it goes to say that once the revenues from crude oil are falling, it affects the output of the government, and the output, i.e. the consumption, the output, the import and export, and the government expenditures. It then affects it. That's basically what you see here. So just by tying crude oil exports, and remember, crude oil exports is just a proxy for the price of oil, the exports, the forex receipts, all that is going to be part of crude oil exports. We can see that crude oil exports and GDP growth rates are more or less tied. So if I know, or if I hear on the news that crude oil prices are going down, that tells me in Nigeria that the GDP rate is going to take a hit. And if GDP is going to take a hit, I know that some asset that I have to rebalance. If GDP is coming down, I'm worried about stocks. If GDP is going up, I'm positive about stocks. I'll show that to you guys in next chat. So from here, we can just see that oil and GDP seem to have a relationship, and we have to watch that, right? Let me see if there's any nice questions. Yes, when exports dropped, GDP dropped, correct. Whenever there's a deep GDP, oil fall, GDP falls, correct. And as you can see, yes, that's just it. So this is how we're using indicators to tell us what's going to happen. Now, the real thing is to use this to try to project into the future. We know it's easy to say what happened in the past. So you guys have to now ask yourself, where do you think oil prices would be? Where do you think Nigeria's oil exports would be in the next 2 or 3 years? If you can answer that question, that means you are basically answering where Nigeria's GDP will be in 2 to 3 years. If you know where Nigeria's GDP will be in 2 to 3 years, then you can take investment decisions today. You can get in early and make money. That's the whole idea, guys. You want to project using the trend. Remember, it's a projection. You can be right, you can be wrong, but you are basing it at least on a trend line. Let's go to the next question. If the computer will let me. It normally does this, so I normally have to go out and come back in again. So you guys just give me a sec. I'm out and I'm back in again. Okay. The second question is basically this. What about the crude oil and stocks? Is there a relationship? So I keep the same oil exports, but here on the right-hand side, I've put the Nigerian Stock Exchange All Share Index. So that captures the direction of all the shares listed on the Nigerian Stock Exchange. So let's compare the stock exchange with oil prices. Is there any correlation, guys? Do you guys see anything that is worthy of correlation? If you chat, I'll see it, but then I'll just go ahead and answer if you guys don't come. So if you look again, it's almost the same thing. Look at 2016, look at 2016. Look at 2020, look at 2020. Let's look for a top. Look at 2019, look at 2019. When you had the rise in crude oil prices or crude oil exports, the stock market also went up. When you had a fall in 2016, 2020, the stock market also fell, right? So the stock market and the oil exports are also somewhat tied together, where stocks are going up, oil prices is driven basically by oil price growth. Why? It's very simple. The more money Nigerians get, the more money they can spend. Remember, when you are buying shares, you are quote unquote consuming, you are spending, right? So the more money you have from crude oil, the more you can spend. That's really what it is. So let me see if anybody has any contrary view to that. I don't see. I think you guys are all agreeing that if you're spending more, then the GDP would then go up. And if that spending is going to be done in the stock market, it should also go up. Yes, so oil price and the performance of the NSE are positively correlated. Yes, somewhat. I would agree. So what we then know is this. If somebody asks you, hey, is shares a good place to invest in? You say, well, it depends. Depends on what? It depends on the price of crude oil. What's the connection? Well, if Nigeria sells more crude oil, Nigeria gets more money. Nigeria gets more money, states get more money, employers get more money. So employers can pay more, can issue more contracts, people can make contracts, have excess capital, and then go invest in the stock markets. That's the really connection, more or less. And it's just that simple. So just like how we talked about the oil exports and GDP, also with oil exports and prices in the stock market, we see somewhat a correlation. Let's do the next one and see what that's going to reveal to us. So the next guy I had here was, what about food, guys? What do you guys think about food? What I've done here is I've put the oil prices and I've put food. On Twitter, I think it was last year, I had a conversation where I asked people, if the price of crude oil goes up, does it affect the price of Gary in Nigeria? Almost everybody said yes, 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 yes. Okay, it does not. The answer is it does not. Crude oil, prices are going up in Nigeria, driven more by emotional, more by perception than by actual data. So the market to my ears, oil price has gone up. Okay, so she increases her price. There is no direct correlation because the oil price, you guys are going to disagree, I know. The oil price going up does not change anything in a small village in Abia State. You can say the cost of transportation to take the Gary from Abia State is going to go up because oil price is going up. I agree. But does it change the price of that commodity in Abia? Does it really affect it? And to what extent? That's really the question. To what extent? Let's look at the data. We've kept foreign exchange reserves. And again, foreign exchange reserves is still the same thing as oil exports. Because when Nigeria sells crude oil, we put money into the foreign reserves, correct? So the CBN takes the dollars, pays the state and the federal Naira, and reserves that dollar in the foreign reserves. So the foreign reserves are going to mirror the rise and fall in crude oil prices. So that's what we have on the left. On the right-hand side, you have food inflation. Now, what just comes to mind, even just a visual interpretation, you can see that from 2012 to 2016, the exchange went up, it crashed. But look at food. Food is almost just on a straight line. From 2012 to 2016, food prices didn't go up. They were just like, they're just almost a straight line, almost, not more than 13%. But you can see the big hump in 2013 and a crash in terms of foreign exchange reserves. What else is happening? As foreign reserves are also coming back down, you can see food prices are going back up. So again, remember what I talked about this food price, and I said it's an outlier. What's happening with food inflation is really externalities. It's an outlier because you're now having external forces, not directly tied to food, but affecting the price of food. So if farmers cannot go and farm and harvest, that's going to affect the supply of food, which is going to make the cost go up. That's why you see the food inflation. But who wants to take a guess? Is oil moving local food prices in Nigeria? If oil prices go up and down, does it make the price of yam in Benue go up and down? What do you guys think? Let me go to your chats and see what you guys are saying. Supplies have more influence on prices than oil prices. So this guy is saying, I think he is saying that the supply of food has a higher influence than the oil price. So let's just understand, oil prices would affect local prices, yes, but what is the key driver? Is it the oil price or is it supply? From what we're seeing here, it's supply, because we've reduced the supply of Gari in Abia, so the price goes up. Even if oil price crashed to 1 to 1 and there was no supply of Gary in Abia, the price will still go up. So the key driver is not the oil price. The key driver is the supply. Because supply of food in Nigeria is still not meeting local demand, then the price is going up. Right? Subsidy has nothing to do with it. Subsidy has nothing to do with it. We're just asking if the price goes up or down, does it affect the price of food? Even if it does, what is the key driver of food and of prices in Nigeria? Is the supply. So if tomorrow if the borders were all opened and there was no conflict in the middle belt or in the north and the food was flowing, prices will fall irrespective of what crude oil price is. But if crude oil prices tomorrow fell to $10 a barrel, and we still have issues of the closed borders and fighting in the Middle East, Middle Belt, and all that, food will still be up. You get the point I'm making? So the key driver for food is a supply of local food to meet local demand, not the external price of crude oil. What's driving that food inflation to almost 24% is the supply. There is no supply. If supply improves, the price of food is going to go down. Could crude oil prices also affect supply of food? Yes. Crude oil prices affect the price of food. Yes. But what is the bigger driver? I just give you the example. If crude oil goes to $10 a barrel tomorrow, that is, it crashes, will food prices crash? Not really. If there is no supply of food, the price will still stay up. But if oil price is 150 tomorrow, so the price goes up and supply is still limited, prices for food in Nigeria will still be up. So what's going to reduce the price of food in Nigeria is going to be the supply, productivity, storage, processing to get the supply from the harvest to the tables in Lagos, Port Harcourt, and Abuja. If we cannot get supply of food, then the price is going to keep on staying high. So oil really is not a direct or is not the key driver for food in Nigeria, in my opinion, because if there's no supply, the price of crude oil is really immaterial. But you can argue, I'm not law. We can hold an opinion. I'm just trying to what I see on the data set. Okay, let's move on, guys. Thanks for the discussions. You guys are really on it today. Sorry I have to keep on doing this, but yeah. Okay. So then we're also having this debate in Nigeria that does Nigeria have a revenue problem or does Nigeria have a spending problem? So I mean, I just put the data up there for us to just take a look at it and say, okay, what's Nigeria's revenue? What's Nigeria spending? Where's the problem coming from? Is it a revenue problem that, i.e., we're not making enough money, or are we just spending too much? What's really the answer? And this chart is very, very nice. If you look at the revenues and the spending, look at the below, you will see the actual, the previous, the highest, the lowest, and the dates. On revenues, from the period 2011 till 2021, the highest revenue, just if you pick that's going to be in billions, the highest revenue you see there, is 1480. That's billion. So the highest data point for revenues in those 10 years was that's about 1,480,000,000,000. That highest data point. Let's look at spending. Again, we have the actual, the previous, the highest, the lowest, the numbers at the bottom. What's the highest figure we can see for spending? Is nearly 2.3 trillion. So without just looking at it like a 5-year-old kid and just saying, what's going on here? You can clearly say Nigeria is spending much, much more than Nigeria is making. Clearly, you can that's a point. And even if you look at the data set on the left, the average you could say is that, okay, 1.2 trillion is going to be like the average across the board because only in 2 quarters did the figure surpass 1.2 trillion. But if you come back to the spending chart on the right. My God, we're almost at 2.5 trillion on just that one quarter. But apart from that, we are really at about 1.2, 1.3 for many years, all the way from 2011. So Nigeria is really spending a lot. The issue, to my mind, is not the revenue. More revenue would help, but I think it's the expenditures. We are really spending a lot of money. Let me give you guys a data set. All the money Nigeria makes from crude oil, all the money, 100% Nigeria makes from crude oil, is going to pay the salaries, service-wide votes, and pension allowances of only civil servants in Nigeria. So all the money, the total money Nigeria makes in exporting crude oil is simply going to the civil servants in Nigeria. We borrow to build roads and bridges and all that kind of stuff. That's not sustainable. You can't have an economy where the crude oil is paying salaries and then we're borrowing to build roads. That's not sustainable. So I just put it out there so someone can run with it. Yeah, but that's what the data set is telling us. Okay. And let's go to the next one. I just have this interesting one. We're almost going to be done, guys, and then we can take all the questions. And again, when we do questions, I don't leave till you guys ask me to leave. So I'm going to be here till you guys ask your last question. Not to worry. I also put red flags for Nigeria. Also just using indicators to say what are the red flags you can watch out for. There are many red flags that I saw, but I picked the manufacturing production, because really from 2014 or 2015, manufacturing has just crashed in Nigeria, literally crashed. You can see the chart. From negative, we're going to about 5, we used to do on the average about 15. Now we can't even get to 5. So it has just crashed. How can we have an economy where we're not manufacturing, or manufacturing is less than 1% of the economy? We can't do that. That's not sustainable, which is why we're importing. We're not making things in Nigeria, so we're importing. And if we're importing, the Naira is going lower. And when Naira goes lower, the manufacturers need more forex to then buy more imported goods. So if they buy more imported goods, prices go up because of inflation. So you see the vicious circle. If you keep on importing, you are simply importing the higher dollar prices, which then leads to imported inflation, more or less. Same thing with the foreign direct investments. Nigeria used to be the #1 destination for investments in Africa. So that's falling. That's the worry for me, that we have to, I think, get back FDIs up, because FDIs create local jobs. So we want to focus on creating local jobs, and also manufacturing production. That's really crashed. Those are two areas where Nigeria can do something really good. What about the good part, the good story? Look at our ease of business. So we've gone from 131 and then we crashed to 170, but we've come back down to 131. So you can look at it two ways. Okay, we're back to where we started from in 2011, but that just means that we're back there. So ease of business is improving, but really we're just back to where we were in 2021. So that means we can do better in 2011, I mean. So we can do better, but at least that's a big improvement from 170 to 130. And I must give the guys that are doing that credit, year one day and the rest. What about private sector credit? That's going up, so that's good. That means more private sector guys are getting credit. The banks are lending more to the local economy, and they're hoping that this to create jobs. We see more lending going to agriculture, more lending going to real sector. The CBN has been very, very aggressive. We must commend them on that, to get funds at low single digits to manufacturers in Nigeria. So we must commend them on that. So this to me are green shoots that I think we can work on. Okay, guys, so I think we've come to the end. Like I said, these are the forecasts. This is what trading economics is saying, that they are forecasts for currency, stock markets, and government bonds. Like I said, you can do this yourself. You can go back and ask yourself, you now know currency, you know the drivers of currency in Nigeria. You know its import, you know its export, you know its remittances, FDIs, FPI. So you want to ask yourself, will remittances go up? If remittances are going to go up and exports will go up, and imports will come down, the Naira will gain value and the dollar will fall. If it's the reverse, if imports are up and remittances are down and exports are down, then the dollar is going to go up and Naira is going to fall. That's really it. That's really what that forecast is telling you guys. All right, guys, we've come to the end of my side of talking to you guys. Now we're not gonna have a conversation. Sorry, I like to wait till the end to take the questions, but we'll have a call to action. So hey guys, try to see if you can subscribe to the podcast that we do. The way I see it, it's on all podcast stations, Apple, Twitter, and all that. It's all there. Just the way I see it, Kaloja, it should pop up for you. We're going to YouTube. We're going to put this up on YouTube. Also subscribe. We're on Twitter and also Patreon. If you want to support the good work we're doing, I would appreciate that. So at this stage, let's just take a few questions. Let me first of all look at the charts, cleared all the charts up. Yes, yes. I don't believe the ease of doing business is getting any better. It's getting better. We've gone from 171 to 131. I think in terms of access of credit, Nigeria is amongst the top 20 in the world, I think. I think that's the one I saw, access to credit. So we're doing well. I think some part needs improvement. Apapa Ports is doing better. They might still be clogged, but it's doing a lot better now. Rails look like they're up. So some good things, some good parts, yeah, but I think we're doing better. Will there be a recording of this session? Yes, everything is being recorded, so it'll be YouTube, it'll be on YouTube, and I also put it on Twitter for you guys to follow. What is the unit of ease of business? Ease of business has about 8 or 13 different segments that they score you on based on peer grouping. So you have starting a business, you have regulatory, you have all that sort of stuff, and then you have to then score, and then you have a general composite score. So you can just Google ease of business Nigeria and it'll pop up and you can see how they got that score really. Okay, guys, let me go to the questions. Yeah, those are the chats. Lots of questions here. Taking a look at the GDP table, has depreciation in local currency been a factor that affected the value of national output? It's a turnaround question, but the answer is yes, Adeni, because why? When you are importing with a weaker currency, then you are importing that inflation because you're using more Naira to import a dollar denominated asset. So if you are importing rice into Nigeria, you're going to use more Naira to import the same rice. So that rice will now have the dollar inflation, or should we say the Naira inflation that's used to buy that dollar. So prices then go up. So if the prices go up, then consumption goes down and that affects your GDP. There are many ways to look at it, but the answer is yes. If your currency is really falling, then and you are importing, then you are importing higher priced foreign goods, and of course it affects your consumption. Many ways to look at it, just the way I can keep it a bit simple. Could rebasing the GDP lead to increased inflation? No, there's no correlation with rebasing the GDP and inflation. Rebasing simply means you have 10 children, and last time you counted your children, that was 10 years ago, but you just married lots of wives, and you're not sure if you have new children. So you do a new census. You find 2 new kids. So you've rebased your economy. So in Nigeria's case, Nigeria was not counting Nollywood in her GDP. And Nollywood was the largest employer of labor in Nigeria after the government. So when Nigeria rebased, services, which was Nollywood, became a huge part of GDP. And that's what allowed Nigeria to become the largest economy in Africa. Stuff like Nollywood, the IT boys and all that came in and boosted the GDP. That's why we basically went up. So rebasing and inflation are 2 different terms. I don't think they connect. Can government print money, employ people, and pay salary with the newest printed money? Will this lead to inflation? Yes. Once you print money, you are debasing the currency. If printing money was a solution, then Venezuela and Zimbabwe would be richer than the United States of America. So money is not wealth. Let me say it again. Money is not wealth. Money is a consequence of wealth. When you produce stuff, you make wealth. Then money is what you use to measure that wealth. If you are not producing and you create money, the money has no backing. so it's worthless. So if you simply print money without having a backing, say crude oil or Nollywood or agriculture, then that money is worthless and it will lead to inflation. Tell talk about, yeah. Thank you for the questions, guys. I appreciate them. Let me just scroll down. And I'm going to be here till we're done. No rush. If you want to go, it's going to be recorded. But I'm going to take all the questions. Anything you ask me, I will answer. Recorded audio, yes, you will get the recorded audio. What are the factors responsible for the massive crash in manufacturing? What do you think? Power, security, cost of credit, all that stuff is all affecting manufacturing in Nigeria, really. That's just it. There are lots of things going on with manufacturing, higher taxes. I would say mostly power supply really is really a big factor. I mean, Nigeria is 60 years old. Nigeria has never distributed more than 10,000 megawatts of power in 60 years. This is an oil funded, the largest economy in Africa. We cannot distribute more than 10,000 megawatts. So that just tells you. Will digital assets like cryptocurrency affect inflation directly? No, I think cryptocurrencies are rising because of inflation. People are now buying digital currencies like Bitcoin because those currencies tend to hold their value better than fiat, which is like the paper currency that you have. That's why they are going up. I think that's the relationship. The more there's inflation, you're going to see more people are going to run towards digital currencies like Bitcoin. Does the CBN bureaucracy with respect to businesses receiving huge inflow from overseas affect ease of? So I'm not really sure if your question, Chibuze, but FDIs and remittances are kind of different. FDI is more of a formalized, like you see when GE, General Electric, comes to Calabar, that's FDI, foreign direct investment. Remittances is when your brother sends you $100 from America for Christmas. That's remittances. All that's about 25 billion if you add it all up. And that's just official figures. I think it's much more than that. So remittances are very, very key. And yes, the remittances can go through CBN or they can go through someone travel and just brings in his pocket and gives it to you. But two different concepts, but very, very important concepts. You cannot print money and spend on infrastructure alone because you are printing money. You can do it on infrastructure, yes, which is what the government is doing today. It's called deficit financing. If you look at the government budget, it's a deficit financing. So the government says we're going to earn $1 billion, but we're going to spend 2 billion. Where's that extra 1 billion coming from? They're going to borrow it, they're going to print it. They print it and then they invest it. The problem is this: if you want to print money and build a railway, that's fine if you're going to then tax that railway and pay back. But if you are printing money to pay salaries, which is more or less a consumptive, you are consuming, that's going to be a problem because there's now no way for you to get that money back to pay off that debt. Debt is front-loaded consumption. If you take loan today, that means you've taken your income in future for today. So you have to make revenues today to pay back. So the issue is not printing money to, again, I agree with you. The US is printing money. The whole world is printing money. The issue is when you print that money, what do you do with it? If you waste the printing money, then the money becomes worthless. Taking a look at the GDP table, has depreciation in local currency been a factor affect national output? I think I've answered that. Okay, I think I've answered all these guys. So 12 questions. How do you explain private sector credit going up, but manufacturing is low? Private sector credit could be going to trading because services is a big sector in Nigeria. So people could be borrowing money to import or to borrow money to go to agriculture or borrow money for Nollywood or for telecoms. Those sectors are growing, but manufacturing is not growing. That's the point I'm making. The largest company in Nigeria is Dangote by market capitalization. They have ways of getting money at a very, very cheap. They could borrow abroad, so they could not maybe borrow from Nigerian banks. So you might not see that show up on that borrowing. But manufacturing is really crashing, and that private sector credit could be going to other sectors, not manufacturing. Yeah. Let's see. Can you talk about FDI a bit and what this is about investors' confidence and their outlook for the Nigerian economy? Yes, I could talk about it. Yeah, if the foreign if foreigners like your country, they invest in your country. It's that simple. If there's business confidence, then there's more FDIs. So the FDIs are a proxy on business confidence, on corruption. When you hear Twitter was in Ghana, and people are saying, "Oh, Twitter can go wherever they like." No, those things matter, because when Twitter goes to Ghana, the message being sent to the Americans that, oh, Ghana is quote unquote a better destination. It doesn't matter what we think, that's the message being sent. So if Twitter is in Ghana and there's a developer that wants to go to Africa, where would he go to? He'll go to Ghana, because Twitter went to Ghana. He doesn't know Nigeria, doesn't know Ghana. Those guys don't know Nigeria or Ghana. But if Twitter went to Ghana, well, I'm going to go to Ghana as well. So that's the thing we have to worry about. We have to make sure that we attract foreign direct investments. Very, very important. Yeah. Well, so I think we're good, guys. I don't see any new questions, and I've seen lots of great questions. So unless something good comes up, let me look at the chat again. The chat guys are really active. How has the devaluation policy of CBN affected exchange rates? Well, Kevin, that's exactly what devaluation does. Devaluation makes the Naira weaker in relation to the dollar. Now, remember, devaluation is not a bad thing. You can devalue your currency as a strategy if you are exporting, because if you devalue, then your exports are cheaper. So if Nigeria is selling cocoa and Ghana is selling cocoa, Nigeria can devalue the Naira so that if foreigners want to buy cocoa they can buy Nigerian cocoa cheaper than Ghanaian cocoa. So devaluation is not a bad word. The thing is, if you devalue simply because you are reacting, that's when it's bad. The CBN has a policy of capital control. So there's a tight grain on what you can go to the CBN to get Forex for. You can't go to the CBN and import with CBN dollars to import, say, rice. Now they're adding maize, they're going to add sugar and all that. All that is all well and good. The intention is good, but it creates anomalies in the market. I would prefer a situation where the marketplace says it's open. If you want to import rice, go and get dollars from the bank and pay. That's what I would expect. And if rice comes and it's expensive, people leave rice and eat fufu, and then the price adjusts itself. But the artificial holding of the dollar or trying to set a rate for dollar is just going to be a subsidy. Let the market determine the rate, then the marketplace will determine what we want to import. If Nigerians can import rice, Nigerians can import rice. It's that simple. Then we have to then focus on growing the local rice market. What happens to a country's economy if the country decides to adopt a cryptocurrency like Bitcoin as its fiat? Well, look, what if you adopt Bitcoin and Bitcoin crashes? Then what happens? So imagine if the pension funds were all in Bitcoin and then Bitcoin crashed tomorrow. So you've lost your pension. That's the bad thing. But the good thing is that you are having a currency that is not devalued. But remember, if your currency cannot devalue, then how can you print money and build that bridge? That means any money you need to build a bridge, you must earn, which means Nigeria must earn taxes to build roads. I mean, if you did that, you might not grow economically. The reason why economies grow fast is really because you can borrow. You look at your personal life. If you want to build a house, you go to a bank and you borrow to build a house. You might be blessed to have the cash, but you have to go to a bank to get a mortgage. It's the same thing. Imagine if you had to save before you could buy a house. When would you save enough to buy a house? So that's the same thing. So there's no right answer. There's no best option. If you don't devalue your currency, or if you cannot borrow or have a deficit spending, then you might not be able to build quote unquote a house. But if you do deficit spending, you open up your currency to devaluation, right? Can you talk on why interest rates are increasing to curb inflation and its effect on exchange rate? Yeah, so inflation more or less is too much money chasing too few goods. So it's two things happening. Number one, it's money moving in the economy and not finding goods to buy. There might be no goods because there's less supply, or it might just be simply too much money, like in Zimbabwe, right? So that's really what's causing inflation. How the government fights inflation is to raise interest rates. So if the government makes interest rates high, then people stop buying things and simply take their cash and put in a bank to earn a high rate of return. So if there's less cash in the economy, then inflation goes down because there's now less cash chasing those goods. That's the whole idea. So when you have inflation, I'm sorry, you have to raise the rates to fight that inflation. And once you raise the rates, then of course the currency becomes in quotes devalued per se. Then people then start to look at forex like the dollar to maintain of their value. So the thing is, interest rates, exchange rates, you can't win with them. You either have a strong currency, yeah, and you use your foreign reserves and you defend your currency, or you have a weak currency and you have a strong foreign reserves. You really can't eat your cake and have it. So you have to say, which one do you want to go for? Do you want the weak naira or do you want a strong naira? For me personally, because Nigeria is exporting crude oil and is getting lots of money from dollars, which we then convert to naira and pay local salaries, Nigeria needs a weak currency, not a strong currency. That's just me. But anybody can disagree, but that's just me. That's a new message. This guy is asking, does increase in share prices contribute to core inflation? I think it's the other way around. I think when there's inflation, then share prices adjust to market prices, which is the inflationary price. So for instance, what I'm saying is this: if GT is just 20 naira, without GT doing anything, if inflation goes up and you want to buy GT stock will also go up in price. So stock prices tend to, because they are market driven, they tend to reflect the prices. That's the point. So it's not really an earnings thing. It's just that if you want to buy that particular stock, the stock would have gone up because GT price will go up like any other market. That's how I think I can answer that. Let me see if there are more questions on the chat. Yep. Yeah, you're going to get the audio recording. No worries. Don't worry about that too much. Yeah, guys. Okay. Yeah, Mufong, I just spoke about interest rates for you. Did I answer your question? So if you increase interest rates to reduce money supply. So if you reduce money supply, then you are fighting inflation. That's why they increase interest rates. And if you increase interest rate, then you can attract foreign capital to your country. So if interest rates are 20%, then those guys in America will then bring their dollars to Nigeria and invest in the bank to get 20%. That's the whole idea as well. Does that make sense to you? Okay. So again, guys, don't remember that I said we're done per se. If you want to leave, I thank you for listening. Just say thank you for you guys for listening. For me for this long, I appreciate you. Once we're done here, I'll post it up on the chat, and then we can take it from there, right? So thank you guys so much. Do follow, do subscribe. I appreciate you guys. It's about 58 or an hour or so. So I'm just going to end it in about next 15 minutes or so. How can one take advantage of credits such as mortgage? Whoa. How can you take advantage of credit facilities such as a mortgage in banks because it's almost inaccessible? That's beyond my scope, man. That's beyond my scope. Nigeria has no mortgage. All that stuff they call a mortgage, that's not a mortgage. A mortgage should be about 10, 15, 30 years, not 5 years. So we don't yet have a mortgage. Reason why it's another topic on its own, but I say it's tough out there. You should try to go do off plan, buy something and build over the years. That's what I think you should do. Don't really wait for a mortgage in Nigeria because you might wait forever. So try to do a plan, try to get yourself into the real estate game, buy land, see if you can sell the land, and then try to fund something. Yeah, but if you wait for a mortgage, you might wait forever. Yeah, Funshu, I see you. Okay. Yeah, thanks. I appreciate that. You're welcome. All right, guys. I'm just gonna close out the chat now, or if we, in the next 5 minutes we're gonna close out, so we're gonna have a shorter recording time on the on the Zoom. So if you guys have a question, just ask me on Twitter if you don't mind. Yeah, just go to Twitter, FinPlan1, and I'm right there. I'll just ask you a question on Twitter. Just ask me on Twitter and I'll answer. So I'm gonna just shut it down so that way we can close out the session, right? Just ask me on Twitter. All right, guys. Thank you so much. You guys have a good day. Bye.